We are talking about.
And the company paid some bitcoins. And at that time, it was like some 30 warranty expenses accrual for the company.
So these were some issues that, as you were working on the projects,
Today's episode is sponsored by TaiPi. TaiPi revolutionizes enterprise application development, turning business ideas into robust, data, and AI-driven solutions. With TaiPi's drag-and-drop features providing intuitive user interfaces coupled with what-if scenario capabilities, TaiPi empowers business analysts to make insightful decisions that are fundamental to drive today's dynamic business.
we're back, everyone. Hi, Jay. Good to see you again.
Good to see you now.
As we know from our last episodes, Jay is an expert in systems, risk management, accounting, finance, and he is based in San Jose, California.
Asa, and there's no need to introduce Norm again, but again, just for the new listeners, Norm is a CAO, he's worked with multiple public companies, and he's an expert in financial reporting and digital finance transformation. He's based out of Nashville, Tennessee.
That's right. Beautiful Nashville, Tennessee.
Maybe
told
this
these-
time we should talk about Sarbanes-Oxley Act, something very close to me. I was an accountant working in India in Oracle, and SOX came in the US and it absorbed me into the United States. And that's how I ended up working in the United States. I'm dating myself 20 years back. But um, I know this was a significant law that was passed between in 2002, and it had a huge impact in 2002 to 2008, right? So maybe we should talk about that a little bit more.
That's a great idea, Jay. We've been talking about the SEC and how it's evolved over the last several years, but definitely SOX is a big one. So you were a chartered accountant that were certified in India originally. Then,
Right.
okay. And then, and so as a result of Sarbanes-Oxley, that is actually what brought you to the United States then.
Yeah, they wanted somebody who knew, like, was a chartered accountant, who knows Oracle, and who knows how to do IT audit. And I fit those three together. So that's how I came.
Okay. Wow. Wow. Great combination. Sounds like you're the right guy at the right place at the right time.
Right. Yes.
So, yeah. So as we talked about, before, SOX is pretty fascinating. And it had some very huge impacts to corporate governance, especially as a result of two financial debacles that, happened really over 20 years ago now, Enron and WorldCom, as you know, right?
Absolutely. I remember those huge corporate fraud, not just the company, even Arthur Anderson in town. It's one of the top five CPA firms at that time, right? And
Yeah. And just by way of the recollection for some of us, um, basically Enron was huge in the energy sector. They were viewed as a pioneer in energy trading and innovations, but behind the scenes, they were hiding billions of dollars of debt through their off-balance sheet entities, and that really was the way that they were able to overstate some of their earnings.
yeah, off balance sheet entities like accounting, trickery, and deception. And
Yeah, yeah, that's exactly what it was. Unfortunately, basically what they did was they created these special purpose entities, basically shell companies that moved debt off of Enron's parent company books. Now, these are now referred to as variable interest entities. However, the accounting for these, what they call VIEs, has definitely changed as a result of SOX and Enron and, some other accounting matters since then. But for sure, during that time, the accounting for VIEs was strengthened and clarified because um, the SEC wanted to ensure that the company's liabilities and any losses were recorded in the proper set of books, even though they may have been in subsidiaries. So,
Right. Yeah.
as a result of what Enron did, they were able to move off, some of their bad or really loans, if you will, and losses to these offshore entities. So it's pretty outrageous. But what do you? I mean, what's your perspective on it?
No, I think the biggest problem was the lack of accountability, right? I somehow looked at Arthur Anderson and I feel like they're supposed to be part of scrutinizing in it, and it's not just following the letter of the law, also the spirit of the law, which was completely missed out in this case, right? And that's my feeling about that. Yeah.
Yeah.
And I also remember some of the Arthur Anderson partners facing jail time, and the whole company went down, right? And it's great thing. What about WorldCom? What happened there?
WorldCom was really another one that related to the creation of SOX, and this one was not necessarily moving debt off the balance sheet and moving into other entities, but here it was simply just moving expenses and putting them onto the balance sheet when they should not have been put on the
Mm.
balance sheet. So they essentially were able to inflate their income statement by capitalizing certain expenses that really should have been OpEx in a particular period. So things like maintenance expenses were capitalized when in any other scenario, they would be expensed as they're incurred. And so they were able to inflate their income statement as a result of this. Now, this particular accounting manipulation misled the investors because it made the company look a lot stronger than it actually was, and turned out to be one of the largest scandals in U.S. history
Yeah.
that then gave rise to SOX.
Right, right. Like you had the executives lying about the numbers, the auditors looking the other way, and everybody else is left in dark, right? Something had to change. Right?
That's so true. Yeah, that's so true. And so here we are talking about a little bit of the history around why SOX has come about. I know, Jay, your experience and many of the things that you've done over the last several decades relates to SOX. So maybe you can start off with some of your, most interesting stories about what you've encountered as part of your SOX work and SOX implementations.
Sure, sure. I'm gonna not name the companies because some of them is not even public, right? But I'm gonna throw some examples that's gonna raise your questions about like, hey, how does SOX come into picture here, and how do we handle things, right? I had a client, a public listed company, and they called me up. They had a ransomware attack, right? And this was the earlier days, Bitcoin, like that. So they had a whole action environment locked by a ransomware, right? And they'd asked for a Bitcoin to release it. And the company paid some Bitcoins. And at that time, it was like some $30,000 or something, very immaterial amount. But they paid that money to release them out of the ransomware. And luckily, the release of the ransomware worked out. But then I was called in to assess to see whether is it a material weakness, is it a significant deficiency, is it a deficiency, like why and what happened here? How do you go back? And this is before the cybersecurity disclosures came into picture. Now, currently, we have the cybersecurity disclosures, but this is before that, right? So that was one example where it was very nerve wracking because you had this whole production being stuck and we were working day in and day out for that, right? It was an escalation of a privilege problem, but that's a complete topic in itself. Another example was this is also a public company. What they had done was they marked out a date was the project was completion, and then they started recognizing the subscription revenue. But then after some time, they realized that the actual project was a fixed fee project, And when the budget was over, even though the project itself was not done, they were calling it complete, which is completely an incorrect treatment, right? So the company tried to go back and get the actual project completion date. Given how messy their process was, they couldn't. And they went from being a pub company to a private company just because of this. They sold it, they had a distress sale, and then they went from there. And I'm going to throw two more examples, without taking too much time. The next one was basically where you're accounting your revenue at the gross or at the net. Now I think the auditors have got a lot more clarity on how do you capture which is gross, which is net, right? Like, if you're getting a commission, you have to do it net. You can't just do gross. There's so many things that just come in right now, but we had one example of like Groupon is an example, right, of a company which wrongly inflated their top number, which was strong, right? Then the last example I'm going to give you is a very interesting one where they had a warranty expenses accrual for a company. But what they did not include in that was the professional services that needs to be included as part of the warranty. And that sort of threw the whole numbers out, actually. That created a lot of issues.
Interesting. So on these examples, um, from a SOX standpoint, did you implement certain controls to identify these problems and or help the company create a path so that they could certify CFO and CEO could certify the financial statements?
Yes.
So that wouldn't
Interesting, right? These are risks that were not necessarily anticipated during the initial stocks implementation process. And this talks about how, you have to constantly keep evaluating the different, what could go wrong, and then build your controls around that, right? And these are very interesting examples that I wanted to just throw it out here.
Okay. So
That-
these were some issues that, as you were working on the projects, these accounting errors or accounting issues were identified and needed to be addressed. So
Right. Yeah.
you were actually not only helping them implement, a new system of controls, but you are also helping them with some of their basic accounting problems.
Yeah, absolutely. There's so many of these examples that we can give it to you.
Wow. Okay.
Awesome. Perfect. Let's break down the provisions a bit more, Norm. I'm sure, that's something that the listeners would like to hear. Right?
Yeah, I think you touched upon some of them, but some of the main areas are corporate governance, which is requiring sign off by top management of the financials, and then financial reporting, which is ensuring that the the financial statements under the Securities Exchange Act of 1934, Form 10Qs, 10Ks, 8Ks as appropriate, are filed correctly. And then it put some rules around what auditors needed to do and created the PCAOB, as you know.
Awesome. Perfect. Maybe we should start off with corporate governance. Maybe you can spend a little bit more time on that, Norm.
Yeah, and I think you're very familiar with this. Section 302 was a new requirement where CEOs and CFOs certify the financial reports, and their signatures, as you know, are on every 10Q and 10K, where there's a one-page sign-off that they certify the financial statements and attest to the accuracy and veracity of the numbers. And that's pretty significant because a false statement, will potentially include some time behind bars, which nobody wants. And as you remember with Enron, Jeffrey Skilling didn't have to sign off on financial statements, but he actually ended up spending 24 years in prison. That's a long time.
Right.
He was released in 2019, but that's still a long time. And then Bernie Ebbers, who was the leader of WorldCom, he had a 25-year sentence for fraud. Um, he was released also in 2019, but he actually died shortly thereafter.
Yeah,
So,
it's a huge burden to be in prison for 20 years for material wealth.
yeah.
But that must have put a lot of pressure on the whole investment and the executives, right?
I think so. I think so, but it did create the accountability where the CEO, and I think this was with WorldCom, where Bernie Ebbers said, "Well, I don't know what's in the numbers. I'm the CEO. I rely on the CFO to do all that, or the accountants." But that's simply not a good enough answer anymore, which I think is a good thing.
The
So.
corporate governance, right? Like you need to know what's happening on your environment. You can't just say, I do not know. So,
That's so true.
how about financial reporting? Or
Yeah, this is another great one. So Section 404 mandated the establishment of more robust internal controls around financial reporting, and essentially created the concept of internal controls around financial reporting. Right, Jay? You're
yeah,
very familiar with that.
the ICFR, I think it's amazing how, if you think about, like, if you're running a small company, like a coffee shop on the corner, right, and you're the guy who's going to sit there the whole day, you do have internal controls for financial reporting, but it's all you and you're managing it. And as the company becomes bigger, more branches, more things like that, how do you need to have these internal controls? What could go wrong? And looking at it as different layers, like at the business process level, at the IT level, at the overall enterprise level, the culture of the organization. It's an amazing area to have thought about it, and how now we have a much more structured approach to this, right? It's calling out the obvious, but in a very structured manner, right? Like amazing it is. Um, and let's talk about the auditing oversight, the last piece of it.
Yeah, yeah, that's right. Um, Really part of the audit process, is making sure that there's good checks and balances and that there's good segregation of duties. And really looking into those areas deeply by auditors is kind of dictated within generally accepted auditing standards. But I think prior to SOX, there really wasn't an entity that provided oversight of accounting firms, right? It was largely sort of self-governance that was relied upon, where firms would have internal reviews of their work papers, and internal sort of audits of their auditing standards and procedures and adherence to internal rules. But SOX essentially required a higher level of scrutiny, and as I mentioned earlier, created the Public Company Accounting Oversight Board (PCAOB), which really created this board to oversee accounting, the auditing profession.
Yeah.
I remember an auditor partner telling me that he feels kind of uncomfortable being audited by the PCAOB, and
Yeah.
I didn't have too much sympathy for that because I said, "Welcome to our world."
Shamelessly plugging myself. I have a friend of mine, like a 20-year friend. He's working for PCOB, and the amount of diligence he does for every single audit is amazing. He would call me up and say, "Hey, in this system, how do we handle this? Is this done correctly by the auditors?" He's just not relying on the auditors coming back, but he's getting insights from experts around the world and doing it.
Oh, okay. So wow, so you actually had a PCAOB inspector reach out to you to kind of get your expert opinion about how some things should work, right?
Yeah, absolutely. And speaking about trust, you know, other than the executives, who else were impacted a lot by SOX?
Yeah, so it's definitely, besides the executives and auditors, corporate boards were actually um, impacted. from SOX because companies were now required to create independent audit committees. And these audit committees were designed and intended to oversee the audit process and then ensure that the external auditors remained objective. So that didn't exist prior to SOX, if you could really believe that.
Yeah, which is interesting, right? I've sat through a lot of these meetings, and the amount of experience these board members bring into it is amazing, right? But I'm assuming this is also bringing in a lot of corporate transparency.
Yeah, totally. In an ideal world, the board members, certainly, especially in the audit committee, should be independent and not necessarily related to top management. In an ideal world, I'm sure that still exists to some extent, but ideally, they should be completely independent, and certainly not have any evidence of any kind of conflicts of interest. And so the audit committees really shouldn't have any financial ties to the company. Although they do, it's not uncommon for
Yeah.
board members to receive RSUs or options of the company as
Yeah, and with all these Class A, Class B, Class C type stock, and the founders still holding significant amount of control over the board, you know, yeah, there are ways around it. Uh, but but good set of changes. Maybe you should throw some examples of socks actually doing a job and finding issues and things like that.
Yeah, couple quick examples. You're probably familiar with this one. This only happened about 4 years ago. It's a Chinese coffee company called Luckin. They were actually inflating their revenues, but because of financial audits and the audit requirements under SOX, it actually detected the fraud, which is pretty amazing because sometimes fraud, especially if there's collusion, is very difficult to detect. But in this particular case, just some of the SOX audit requirements uncovered the revenue inflation. Uh,
Awesome. Any other interesting case that comes to your mind?
I think one other one could be related to the Nikola Corporation. If you remember here, top management basically stated that they were going to be able to, create a energy clean truck within a very short period of time. But through audit and other reviews, it was determined that those were false statements and required further investigation and ultimately impacted the company. So,
Yeah, it's a Bay Area company, isn't it? Like I remember.
yes, yeah, that's right.
Yeah.
That's right.
Okay, awesome, perfect. Sock has a real impact, but I'm sure it has faced some or a lot of criticism. Maybe we should cover that also now.
That's true. That's true. I mean, as you know, Jay, you had to be hired with your expertise of not only understanding U.S. GAAP and IFRS, but also systems, how they work, as well as performing system related audits. So there's definitely some compliance costs related to that. So I guess how did you manage? Those projects and explain to your clients that, this work is gonna cost some money.
You know, it's about maintaining the trust of the public, right? I think the term trust is very important, especially when you're taking money from public. And it doesn't have to be just retail investors. It could be even institutional investors through the IPO market, right? And if you're having that money, and if you have to earn the trust, you have to do your due diligence to do your trust. And what is the amount of due diligence that you do? How do you establish that, and how do you portray that your due diligence is it sucks to me, right? So I had an example of a client who made a small mistake in their core, and rather than charging 10 $10 per transaction, they ended up charging $8 per transaction, and they lost $3 million because of that. Like simple $2. So we had to go through and talk through with them and say, hey, what is this impact? And so and if you don't have good change management control, or monitoring control. So the impact of something like this could come in, a bad code slipping into your system and things like that, right? So then they have to build another system which was parallelly monitoring the system. So they were maintaining two sets of codes. One was checking the other code. And I was like, that's how you would go back and tell your public that you're having the right due diligence to run this company for you. You're literally servants of the public, right? So they are the owners of the company. Yeah, that's how I push it back. If there is a CFO or a CEO who says SOX is a waste, then there's an entity level control problem, right? The company itself doesn't have the right culture, right? That's how I look at it.
Yeah, that's a great point. Yeah. If top management isn't willing to support uh, internal controls and the testing around internal controls, I think that is an entity level problem. But we all know that on at the highest level, restoring trust in the capital markets is invaluable, um, and that's really what gave rise to kind of going back to our first episode talking about the Securities Act of 1933 and the Securities Exchange Act of 1934, right?
Yeah.
So then, kind of fast forwarding a little bit, I mean, a few years have passed since SOX came about in 2002 and required implementation by 2004. But then we had the Jobs Act that came out in 2012. So there were some changes as a result of that. Maybe you could explain to our audience what some of those changes were.
Perfect. I think along with the Jobs Act, or like even before, a little bit before Jack's fought, there was a new standard that PCOB came out with, which is AS50, which was which cleared the air a lot about how do you go about setting up controls. It sort of reduced the effort required to implement and test it. It was going crazy before that, but I love the impact of AS15 in overall stocks world. Post that, with the Jobs Act, we had this change that came in, which came up with a new category called the emerging growth companies, right? And there were certain changes that were uh, came in through EGC's companies where they're not required, to the 302B, right? So that's the key thing. Sorry, 404B. Sorry, the 302 and 404 is remains the same, but 404B is not required for emerging growth companies. And that was a critical change, and that reduced the effort or the cost involved in being a public company for smaller company.
Okay. And so that sounds consistent with what the objective behind the Jobs Act of 2012 was, right? It was to help smaller companies raise money and grow and, have access to capital and kind of build a business.
Right.
So I don't know. We in our last discussion we talked about some examples of where companies that did grow pretty rapidly during after the Jobs Act was passed in 2012, they did have some struggles, but maybe that's not related to internal controls. Maybe it was just the business model itself that was flawed. But thanks for that clarification. There's one other area that I think is worth just kind of touching upon, and that's maybe you've heard of IPEs or information prepared by the entity, right? And that's an interesting one because with your knowledge of systems and how systems actually generate data that the auditors or really the company management rely upon, has to be audited as well. And so, do you have any story or insight that you can share on how
Uh,
you went about auditing IPE?
I'll give you an example. I was auditing a company and I was looking at very simple dumb data, list of employees, their roles, and making sure that the roles are being correctly done. Very simple, low level risk control, whatever, right? And And I was looking at it, quarter one versus quarter two and quarter three, the same set of users, the same set of roles. I'm like, something doesn't make sense. How come they didn't hire anybody? They didn't fire anybody, right? So and then I go back and check. They were not pulling this list from production system. They were pulling this list from a sandbox system.
Wow.
Right? So it talks about w- where the data is coming in is so important and how well it is done. It is being done, right? Forget this. This is an IT control. It's easy to pull out of the system, but let's think about a reserve, right, or a goodwill treatment, which is a complicated Excel spreadsheet. There's so many data that is being pulled out, presented in, and all the formulas and things like that is setting it up in there. Now, if you make a smallest mistake in an Excel spreadsheet, and that's going to impact the number, right? So, what is the control that we are doing as accountants to reduce that risk? And that's IPE, Jimmy, right? Right from the stores till it is presented. And IP could manifest for two different ways. One is the data that we provide to the auditors. The other one is the data that we use to do internal control. Both of this could be impacted by IP.
Yeah. Makes sense. That's a great example, Jay.
Yeah, no, you ask me anything, I can give you an example.
Absolutely. You're an
My
expert.
gray hairs come from that.
Yeah, fantastic.
Awesome. Thanks, Norm. It was an exciting conversation today.
Yeah, no, thank you, Jay, for your insight. And for our listeners, if you enjoyed this discussion, be sure to click like, comment, or subscribe to the channel. And don't forget to hit the notification bell so that you don't miss any future episodes. If you have any thoughts on Sarbanes-Oxley and its impact, and anything that has been derived from SOX up to the future, up to the to present, please don't hesitate to comment, and we'd love to hear from you. So until next time, stay transparent, everyone.
Happy New Year.
Bye bye.